Inflation is the increase in prices for goods and services. Inflation decreases the purchasing power of money in an investment portfolio. It affects retirees on a fixed income by reducing the number of goods and services the retirement portfolio can purchase. Many retirees find it difficult to maintain their standard of living when the cost of living increases. To offset inflation, the investment savings account should generate a higher return than the rising inflation rate. Unfortunately, many don't consider inflation's effects on personal finance until it's too late. You need to know that the higher the inflation rate, the more your investments must grow to keep up with higher prices over time. Even though your financial portfolio shows gains and a decent rate of return, the account's value may have decreased. Inflation is a measure of the rate of change in prices. Inflation is an important economic indicator that measures the rate of change in prices. Most countries aim to have a modest inflation rate. The United States, for example, sought to have an inflation rate of 2 to 3%. Above 2 to 3%, the Federal Reserve Chair would have normally increased interest rates to make money more challenging to obtain and start cooling off the market to prevent a massive erosion of savings or requiring adjustments to Social Security payments for individuals on a fixed income. The Consumer Price Index (CPI) program produces monthly data on changes in the prices paid by urban consumers for a representative basket of goods and services to track inflation increases. There are separate indexes for two groups or populations of consumers. CPI for all urban consumers, CPI-U, is the index most often reported by the national media. At the same time, CPI for urban wage earners and clerical workers, CPI-W, is the index most often used for wage escalation agreements. You can hedge against inflation with certain investments. When it comes to inflation, a good investment can protect your money from losing value. There are a few types of investments that offer this protection. 1. Stocks. 2. Bonds. 3. Cash. 4. Mutual funds. 5. Inflation hedges. 6. Real estate. 7. Physical gold and other precious metals. Stocks, bonds, mutual funds, cash. These first four types of investments are traditional staples for retirement planning and personal finance but usually don't provide the best protection against market turmoil. While these are part of a well-diversified retirement portfolio, and except for cash, they have the propensity to keep pace with inflation as the market sees higher prices. These are subject to devaluation when the economy takes a downturn. Inflation hedges. Inflation hedges tend to be less desirable when the overall market is doing well. This is because they do not generate the same high returns as some other options. However, these are essential to personal finance retirement planning. Inflation hedges can help preserve your purchasing power during economic downturns. Hedges are ideal when inflation rates are at record highs, as seen in 2022. Real estate. Real estate investments can help offset inflation, providing stability, increased equity, and income potential. It's important to remember that real estate is not a guaranteed hedge against inflation and does come with risk. Physical gold and other precious metals. Gold is one of the original currency denominations recognized worldwide for its stored value. Financial advisors at large banks such as Wells Fargo and Bank of America predict a massive increase in gold. Elites have used precious metals such as gold, silver, platinum, and palladium as natural hedges against inflationary risks in their portfolio. It's essential to have a diversified portfolio if you want to protect your money from the erosive effects of inflation over time. This means having assets like stocks, bonds, commodities, precious metals, and short-term investments in your retirement portfolio. These options provide some volatility, which is necessary for long-term returns. What are the risks of inflation for retirees? Retirees are especially vulnerable to the erosive effects of inflation. Not only do they have a reduced fixed income, but they also tend to have higher medical care costs than other age groups. It's estimated that healthcare spending for seniors of retirement age is 3 times more than for working adults. Given these factors, it's clear that retirees need to take steps to protect their retirement savings from inflation. Inflation can have a negative impact on your retirement plans. Inflation can have a negative impact on your retirement plans. This is because retirees tend to invest in assets that are less impacted by inflation, such as short-term bonds and cash equivalents. However, when interest rates are low, these investments may not generate the same returns as they have in the past. Additionally, if you hold long-term bonds during periods of high inflation, you run the risk of not being able to get your money back at the end of the bond's life. Retirees should work with fiduciary advisors to stress test different scenarios, like rising inflation. This will help them understand how this event might impact their retirement plan. It is also crucial for retirees to remember that the risk of inflation is that the investment does not keep up with the pace of inflation and loses value over time. Your retirement savings won't last as long if inflation eats into their value. Medical advances continue, which means people may live into their 80s, 90s, or 100s. This makes it likely that retirees may need more than 30 years of retirement income to support their standard of living. According to the Social Security website, Social Security payments for a retired worker average $1,539.68 per month. To increase Social Security payments, many retirees consider delaying Social Security payments. Delaying Social Security payments increase benefits by a percentage, known as delayed retirement credits. Delayed retirement credits are added every month the payments are delayed up to 8%. Viewpoints on Fidelity discuss the risks and benefits of an inflation-indexed annuity. While its cost can be challenging to predict, the savings rates will not always keep up with the rising costs, forcing retirees to rely on their investments for income. No universal solution exists. Every retiree must adjust their plan accordingly. Inflation can reduce the value of your bonds. When looking for a way to save for retirement, you may have considered buying bonds. Bonds are investments that pay out interest over time, and the principal is repaid at maturity. However, one big problem with investing in bonds is that inflation can reduce their value. This happens because your dollar buys less and less as prices go up. For example, if the inflation rate is 3% and you hold a bond that pays 2%, in real terms, you're losing money each year. There are ways to protect yourself from inflation while still investing in bonds. One option is to buy shorter-term bonds, which will let you invest and mature at higher interest rates more quickly than if you had longer-term bonds. Inflation can increase the cost of healthcare. Healthcare expenses have increased at a rate above overall inflation, and many retirees are finding it hard to cover healthcare expenses. There are several ways to combat this trend, including 1. Saving in a health savings account, HSA. 2. HSAs allow you to save money tax-free to cover qualified medical expenses. 3. Purchasing long-term care insurance. 4. This type of insurance can help cover costs associated with long-term care, such as nursing home stays or assisted living facilities. 5. Retirement accounts also offer ways to plan for rising healthcare costs. 6. For example, if you're over 50, 401ks and IRAs allow you to save money more pre-tax by using catch-up contributions which can be used for healthcare expenses in retirement. Finally, it is essential to remember that Medicare is not a comprehensive health insurance plan. Be sure to familiarize yourself with what your coverage entails once you retire and use that information to plan for the future. What are some strategies for protecting your retirement savings from inflation? Hedge with commodities. Financial experts often refer to investments that protect your savings from inflation as hedges. Hedges are investments that protect your property from falling dollar values. Inflation hedges are a good idea as long as the hedge investments are mainly composed of commodities and not solely stocks or bonds. Commodities have an inherent value, meaning their prices tend to rise with inflation. The strategy is most effective when used to purchase physical goods with a high liquidity rate like gold, silver, palladium, and platinum. Self-directed IRAs can hold gold and silver in a retirement portfolio through a self-directed IRA. See the 5 best gold IRA companies list provided by Gold Hill Retreat. Investors can use commodities to diversify and reduce risk and make their investment more secure. Invest in Treasury inflation-protected securities. TIPS are a type of bond which adjusts their principal according to the Consumer Price Index, CPI. This means that they offer protection against inflation. The principal amount is guaranteed upon maturity of the bond, so investors can be confident that their investment will not lose value over time. TIPS investments are not impacted by rising inflation and higher prices. As inflation rises, TIPS adjust the price, principal amount, to maintain their real purchasing value rather than increase yield. This makes them an attractive option for investors in times of high inflation who will live on a fixed income. Consider real estate. One way to help protect your retirement savings from inflation is to consider investing in real estate. This can be done through a real estate investment trust or REIT. When a REIT becomes a public company, all property-related income becomes exempt from federal income tax. Many focus on one property type, such as offices, apartments, or industrial sites. Some concentrate on mortgages only, while others diversify into several property types at once. REITs are a way to invest in real estate without the tenant and maintenance issues that often come with being a landlord. The paid-out dividends will increase over time, which is helpful for investors looking to protect their retirement savings from inflation. Create a self-directed IRA to hold non-traditional assets in your retirement account. A Gold IRA, a self-directed IRA, is an individual retirement account that allows you to hold physical assets like gold, silver, platinum, and palladium. These assets can provide stability during times of market volatility and can help to protect savings from inflation. What are some tips for minimizing the effects of inflation on your retirement savings? Number 1 way to protect your retirement is to check your emotions. One of the best ways to protect your retirement savings is to check your emotions at the door. When the markets are in turmoil, it's easy to let fear or greed take over and make decisions based on those feelings rather than reason. Instead, 1. Asset allocation funds have a diversified portfolio and target retirement dates. 2. This means they will automatically rebalance their holdings when the market takes a downturn, so you don't have to worry about making knee-jerk decisions. 3. Target date funds put your savings on autopilot, with adjustments based on your targeted retirement date. 3. This takes the emotion out of decision-making, so you can be assured that your money is working for you even when you're not paying attention. 4. Follow your investment strategy. 5. When retirement planning, make a plan with a fiduciary, someone who is legally obligated to act in your best interests, not their own. 6. This way, you can be sure that someone is always watching out for your financial well-being. 6. No matter what happens in the market, save early and often. One of the best ways to minimize the effects of inflation on your retirement savings is to save early and often. You can do this by 1. Contributing to a retirement account, such as a 401k or IRA. 2. These accounts have tax benefits and allow you to save money pre-tax. 3. Diversifying your portfolio across different asset classes, such as stocks, bonds, and real estate. 4. This can help reduce volatility and improve returns. 5. Open a self-directed IRA. 6. With 3% 15% invested in physical products like gold and silver. If you're interested in learning more about investing in gold, Gold Hill Retreat has done extensive research on the top gold IRA companies. Review your withdrawal strategy regularly. When planning for retirement, it's essential to have a solid withdrawal strategy in place. However, this plan may need to be revisited as time progresses and your circumstances change. For example, as mentioned above, the 4% rule may not be as reliable in the future. You may want to consider withdrawing 3% instead. Additionally, if you are not comfortable with the CPI, Consumer Price Index, consider using the MSPR-ATI Inflation Index instead of relying on your retirement investments alone to ensure a steady income in retirement. And finally, remember that medical expenses will likely continue increasing. According to the Peter G. Peterson Foundation, Americans spend nearly $12,000 yearly on medical expenses. So make sure you factor these costs into your overall budget. Keep an eye on the economy. It's essential to be aware of the economy when retirement planning. The stock market has outperformed the CPI since World War II, so it can be a good idea to include stocks in your portfolio. However, remember that the market as a whole doesn't always rise. It's essential to plan your portfolio based on your individual needs. In addition, you should also include bonds in your portfolio for income and stability during market downturns. How can you adjust your retirement savings plan to account for inflation? Why aren't you saving enough for retirement? It's no secret that Americans aren't saving enough for retirement. A study by the Economic Policy Institute found that, in 2013, the median retirement savings for all working-age families was just $95,776. There are many reasons why people might not be saving enough for retirement. People might not be saving enough because they don't have access to affordable retirement plans like 401k or IRA accounts. Another reason is rising prices of essential expenses and healthcare expenses are eating into discretionary money. According to Barclaycard, consumers show signs of the cost of living squeeze, which sees almost half of all the UK card transactions. Barclays notes that virtually all non-essential expenses have declined, ranging from furniture to sporting entertainment. It would be nice if wages were to keep pace with inflation, but they are not. The average person has started weighing the cost of retirement savings versus purchasing essentials. Consider healthcare costs. When planning for retirement, it's essential to consider all the potential costs that come with it. This includes not just regular expenses like housing and food but also healthcare out-of-pocket costs. One of the significant healthcare costs associated with retirement is long-term care. According to Senior Living, the average annual cost of a semi-private room in a nursing home is $94,900, and the average yearly cost of assisted living facilities is $54,000. Home healthcare homemaker services run about $59,495 per year. Significant expenses can quickly add up, so you must plan for them in your retirement savings. One way to do this is by using an HSA to fund long-term care (LTC) costs in retirement, and HSAs have some significant tax advantages over other methods of funding LTC costs. Another thing to keep in mind when planning for retirement is inflation. Inflation can take a big bite out of your savings if you're unprepared for it. That's why adjusting your retirement plan is essential and ensuring you have money set aside for rising prices over time. Inflation-proof your retirement income. No one knows exactly what will happen with the stock market, interest rates, or the economy in the years ahead. However, it's important to take steps to protect the purchasing power in your retirement from inflation and rising medical costs. Here are a few tips. 1. Review your portfolio and adjust your asset allocation to account for inflation. 2. Consider holding more stocks to take advantage of higher returns, but be aware of possible stock market volatility. 3. Avoid overexposure to bonds in a rising interest rate environment. 4. Consider investing in bonds to hedge against inflation. Bonds are a type of investment that pays you back over time with interest, and as rates rise, the price of existing bonds usually falls, meaning you could lose money if you sell them before they mature. However, investing in bonds also provides stability and can help dampen the effects of inflation on your overall portfolio. Invest in real estate indirectly through REITs. Real estate is often seen as a good hedge against inflation. When prices go up for goods and services, rents usually follow suit. By investing in REITs, which own and operate various types of real estate properties, you can gain exposure to this sector without having to become a landlord yourself. Commodities can provide a hedge against inflation and be an attractive investment for those nearing retirement. Commodities are physical goods, such as gold, oil, or wheat, that can be bought and sold on the open market. They can provide a hedge against inflation because their prices usually rise when the cost of living goes up. Elites are purchasing physical precious metals to protect their wealth from currency devaluation. If you're looking for a more long-term solution, financial analysts are predicting gold prices will continue to increase in the coming years, so it may be worth investing in gold. Remember that investing for retirement is a long-term commitment. When calculating your retirement income, account for inflation. Over time, even relatively small amounts of inflation can have a significant impact on how much money you'll have available to spend in retirement. Optimal portfolio allocation for long-term retirement includes optimizing Social Security benefits as well as other sources of income. Investing in inflation-protected securities can help you protect your retirement income from the effects of inflation. Options for investing in inflation-protected securities include TIPS, corporate IPDs, including rights and